According to JP Morgan, a dovish Fed could spark a 10% S&P rally. Not in a week, not in a month, not in a year, in a single day. Let's get into exactly what they have to say, as well as what is happening today in the broad markets, because best believe you guys want to hear this. We're also going to be going over the earnings that we're going to have in the markets over the next couple of days. So let's get straight into this video. Hit that like button and subscribe to the channel if you guys have not already, and I don't want to keep you guys waiting. So let's get straight into it. And first things first, let's talk about what happened in the markets today. And if the markets are down on any given day, the first thing you guys want to look for is to see if the bond yields or the dollar is causing it. And why I say that is because if the bond yields and the dollar are really the biggest driving factors of the day, then it's a lot easier to understand why the markets are doing what they are doing. And really, today, the markets are starting to rally back a lot compared to where they were in the beginning of the day. But nonetheless, the bond market and the dollar are to blame. TLT currently down about 1.30%. It is 3:44 p.m. at the time of recording this video, so it doesn't look like too much is going to happen by the end of the day. Nonetheless, bonds down this much is basically telling you that yields are shooting higher today. And when bond yields go higher, that is bad for the stock market. It's bad for growth stocks. It's bad for basically any kind of lending, right? Because lending rates are pegged to U.S. bonds. Why would you lend out money for 5% if you could get a 4.5% yielding bond? No, you're going to charge 9% to lend out your money to someone else, because the government, you got a lot better chance of them repaying you than some random person. So hopefully that makes some sense, and that's a big reason why the markets are down today, as well as the dollar. No shocker there. The dollar is up 0.82% on the day. Pretty much going straight up from this low that we just seen around 29.48, now sitting at 30.03. You know, when the bonds are down this much today and the dollar's up this much today, it is very, very hard to get any sort of rally in the markets. Only really a select couple of days in 2022 that has actually happened. You typically need the bond market and the dollar to play along to some degree to get that rally, and it's definitely not happening today. So those are the biggest things. You actually did have some data come out from the UK. I believe their inflation rate did beat expectations, and let's go ahead and pull that up right now and see what it says. Eurozone inflation hits a record high of 10.9%. UK mortgage approvals, credit card borrowings fall as it happened. So no, that was not correct. It does not look like they beat on inflation expectations. It was 9.9% in September, now to 10.7% in October. So that is definitely not good. And the 19 nations sharing the euro eked out economic growth of 0.2% in the second quarter, down from 0.8% in the previous quarter. So some bad data, you know, over in Europe, and that is another reason why the markets are not doing so well today. But it's really the bonds and the dollar. So I think that is really secondary to what we're seeing with those other two things here today. Now, nonetheless, let's talk about the earnings we have in store, because besides the Fed, the earnings will still be very, very important. And here in after hours, you don't have too much going on, really not too many notable names to actually cover. But Tuesday pre-market, you have SoFi, Uber, Pfizer, BP, Marathon, Eli Lilly, and Toyota. Those are the bigger ones. And Tuesday and after hours, you have AMD, Devon Energy, Airbnb, Energy Transfer, Chesapeake Energy, and MicroStrategy. Wednesday pre-market, CVS Health, Generic, Humana, Paramount, Estee Lauder, Cedar Fair, Progressive, Canada Goose. So a couple of interesting companies reporting Wednesday pre-market as well. Wednesday after hours, this is where you get some of the larger hitters as well. You got Roku, Qualcomm, Marathon Oil, Robinhood, Etsy. That's basically going to be it for the big dogs. Thursday pre-market, not too much going on. Royal Caribbean Group, Crocs. I do own a small position in Crocs, so I do want to watch what they say about the consumer right there. Datadog, Peloton, Nokia, and then Penn National Gaming. Thursday, after hours, PayPal, Coinbase, Square, or Block, whatever you want to call them, Twilio, Starbucks, Carvana, Cloudflare. And then Friday, pre-market, you have Fubo TV, DraftKings, and Hershey's. Those are going to be some of the bigger earnings that we'll be reporting here this week. Although we have the large earnings out of the way, so I think there's a lot less broad market risk with these earnings. Certain sectors will be affected very, very big, like your healthcare, like your energy, like your fintechs, and even consumer demand for discretionary products. Those certain sectors, could see a big positive boost or big negative drawbacks based on these earnings and the sympathies that could come into play based off of these different companies that will be reporting earnings. Nonetheless, let's talk about exactly what is going on right now. S&P 500 taking another tick to the downside, which again is not surprising in my personal opinion. And AMC here today wanted to get that breakout. We were up quite a bit at one point, all the way up to about $7.26 per share, now trading at $6.64 per share, getting rejected over the past couple of weeks, really, around this, $7.20 range ever since we fell under that. And yet again today, but AMC is still up 2% on the day, which I think is a very bullish thing. And I think some hedge funds are trying to kind of de-risk themselves given if a rally does happen after the Fed, like JP Morgan Chase says could happen. I do gotta quickly log back into this to go ahead and pull up the Ortex data on AMC, but I think that for the broad overview is kind of what is going on today. It's really hard to tell on a day-to-day basis, especially with AMC, but nonetheless, that's kind of what it's looking like as of right now. Now, the live short interest is up 0.5% here on the day. The amount of shares currently sold short sits at 101.53 million. Cost to borrow max at 20.14%, cost to borrow average at 15.16%, and cost to borrow average, or did I say average? Cost to borrow minimum at 15.16%, and cost to borrow average at 18.8%. And it looks like, as you guys can see over here from Interactive Brokers, the cost to borrow rate staying pretty steadfast, about 17.5% over the last couple of days, closer to that 18% mark for most of the time. So that's a very positive thing. That shows a lot of demand, at least from hedge funds trying to short AMC, and that's the best way to look at it. As far as the day, we have seen more option orders coming through for a lot more money. We've seen 11 orders totaling $550.39 thousand, positive order value of 88%. So I think that is also a very bullish sign. Over the past week, we've seen 1.83 million shares or dollars worth of AMC options go into AMC, and that is broken up in 38 orders with a positive order value of 42%. So you're doing almost half that amount, like 30% of that total amount here today with a positive order value of 88%, and the stock is up 2%. So I do think that is very, very good. Now, let's talk about the main thing I wanted to talk about here in this video, and that is JP Morgan says dovish Fed could spark 10% S&P rally. It says, analyst offers a wide range of scenarios for Wednesday's trading outcomes are skewed to the upside, says team led by Tyler. And that's weird because that's my name, but nonetheless, let's get into the article. And this did come out today at 2:09 p.m. Did start a little bit of that bullish kind of turnaround that we started to see throughout the day. It says, while hopes for less aggressive Federal Reserve helped U.S. stocks overcome last week's flurry of disappointing earnings from tech giants, JP Morgan Chase and Company's trading desk now sees room for a massive rally should policymakers turn dovish when they announce their decision on Wednesday. The S&P 500 could surge at least 10% in one day if the central bank raises rates by a slower than expected 0.5 percentage point, and Fed Jerome Powell signals willingness at the press conference to tolerate elevated inflation and a tightening labor market, according to the bank's sales team, including Andrew Tyler. The scenario is the least likely to materialize, yet the most bullish outcome for equity investors, the team wrote in a note to clients on Monday. Laying out every possible scenario on Fed Day, the JP Morgan team is embarking on a high-stakes task of predicting market moves based on an event that has largely been positive for stocks this year. Of the 6 prior meetings, the S&P 500 rose 4 times on Fed Day and fell on the other 2, according to Bloomberg data. To be sure, the bank's economists expect the Fed to boost rates by another 0.75 of a percentage point, in line with the median forecast in a Bloomberg survey, and Tyler's team views other scenarios as less likely. Still, the exercise offers a lens into the risks that investors are grappling with. Quote, "These outcomes are skewed to the upside as our view is that last week the market had every reason to retest lows given the disappointment from the mega cap tech earnings and still moved higher," noted Tyler and his colleagues. Quote, "Several client conversations I focused on trying to identify who is the incremental seller. We think the risk/reward is to the upside," and that does make a whole lot of sense. And here are the scenarios. So it says 50 basis point hike with a dovish press conference. It is difficult to conceive a scenario where the outcome occurs given inflation levels and a tight labor market, the team wrote. Should this outcome occur, the immediate reaction could produce a double-digit one-day return for equities, S&P 500 up 10 to 12%. 50 basis point hike and a hawkish press conference, an outcome that could stem from a Fed that is increasingly concerned about financial stabilities as it balances growth and inflation, S&P 500 up 4 to 5%. 75 basis point hike and a dovish press conference, a scenario viewed as having the second highest probability of playing out. If you saw the Fed give explicit guidance for the December meeting, then it is likely viewed as a dovish outcome, S&P 500 up 2.5 to 3%. So that is the most likely outcome that they are saying right now, is the markets are probably going to be up 2.5 to 3%. The Fed's probably going to have somewhat of a dovish press conference and give us guidance for that December meeting, likely meaning a lower rate hike to come in December. And then it does say 75 basis point hike and a hawkish press conference. This is the most likely outcome, with Powell retaining optionality for December 2023 meetings while emphasizing the current risk to inflation moving higher. The team also views this as the outcome most expected by bond markets, so there may not be a significant move in yields that keeps equities from melting down. S&P 500 down 1% to up 0.5%. 100 basis point hike and a dovish press conference. While this is seen as unlikely as a 50 basis point hike, it may mean the Fed both wants a higher terminal rate and wants to complete the tightening cycle this year. Separately, the market may digest this move as the Fed having prior knowledge of where the next week's CPI prints, S&P 500 down 4 to 5%. 100 basis point hike and a hawkish press conference considered the best outcome for equity bears, waiting for this last rally to dissipate. This would seem to be a Fed reassessing its own inflation forecast, which some investors feel is too optimistic. S&P 500 falls 6 to 8%, likely retesting year-to-date lows. So, guys, that's a lot to take in. Google this if you want to go over these scenarios and figure out which one you think is more likely. Just type this in. JP Morgan says dovish Fed could spark 10% S&P rally. I think that is a very, very good headline. I think it's not that expected. I don't think the Fed's going to take its foot off the gas pedal right now. If it did, that's going to mean that they see something down the lines that is not so good for the economy and not so good for financial conditions. But nonetheless, guys, this is a very big week. I hope you guys are ready to go. You guys are locked and loaded here in the markets. The last thing we're going to talk about is the Fed rate monitor tool and where the probabilities are for 50 or 75 basis points at this next meeting. And it looks like 84.7% of market participants are expecting a 75 basis point rate hike, whereas 15.3% of market participants are expecting a 50 basis point rate hike. So it's not priced into the markets. We are not expecting that 50 basis point rate hike by and large. But a bit of positive news is that, here today you're seeing the federal funds rate probabilities for a 75 basis point rate hike in December coming up to 52.8%, whereas a 50 basis point rate hike is looking like 41.5% likely. And why I say this could be potentially a bullish thing is if you start to see markets get one way or the other too much, if you start to see heading into Wednesday, the markets are firmly pricing in another 75 basis point rate hike in December, and then the Fed says, yeah, we're not going to do another 75 basis point rate hike. Well, a lot of the time, those scenarios produce the most violent rallies because bond market, they don't get it wrong all too often, but when they do, they can get it very wrong and spark some very big rallies. So guys, this is going to be all for this video. Hopefully you guys learned something. Hopefully you found something to take out of this video. If you did, hit that like button and subscribe to the channel. Nonetheless, source your comments, questions, or concerns down below in the comment section. Thank you for watching, and I will see you in the next.